Hello everyone. Welcome to TaxExterminator.com, where we kill taxes dead. I'm going to show you how to reduce your taxes legally beginning today. I'm your host, Brent Jordan, a veteran tax attorney, former UCLA adjunct professor, and current district court trial judge. Today's webinar is entitled The 12 Biggest Tax Mistakes That Cost Business Owners Thousands of Dollars Each Year. The legal authority for this webinar is the IRS Tax Code, United States Treasury Regulations and Tax Court Rulings, and the IRS Revenue Procedures, Private Letter Rulings, Publications, Manual, and Forms. This particular segment is called Wrong Retirement Plan. But before we begin, let's look at a nice little comic strip here. The retired taxpayer is at the IRS office, and the IRS agent says, "Surely you can earn more than this. Someone has to support Medicare and Social Security." We're going to be looking at individual private plans, qualified benefit plans, qualified contribution plans, qualified stock plans, and non-qualified plans. Most business owners' heads spin when they hear those words and try to distinguish between all these plans. So let's make it real simple. As far as an individual private plans are concerned, the IRA is most common and known to business owners. With an IRA, you take pre-tax dollars, put it into an account, the money and investments grow tax-free, and then when you take a distribution, the money is taxed at your current income tax rate. In 2014, the maximum contribution rate for an individual who is 49 years old or less is $5,500. And there's a catch-up plan for those people 50 years and older. They can contribute $6,500 per year. Now here's a dog talking to the financial planner, and the dog says, "I have a diversified retirement portfolio. 40% in bones, 30% in squeaky toys, and 30% in stuff I stole from the cat." Now let's look at another individual private plan known as the Roth IRA. With a Roth IRA, you take after-tax dollars and put them into the Roth IRA, and your money and investment grows tax-free, and when you take a distribution, your money and investments are tax-free. Here's the ages. For people under 49 years old in 2014, like an IRA, the maximum amount of contribution is $5,500, and for people 50 years and older, $6,500. Now here's a guy looking at the world. He's about to retire, and he sees this rocking chair, and he says, "Is this the future?" The final individual private plan is known as a 401k plan. Most people are familiar with this plan. For 2014, if you're 49 years old or under, you can contribute up to $17,500. And for those of you 50 years of age and older, $23,000. Now, here's a wife coming out to her husband who's sitting out on the back patio reading a book. He's just retired, and he says to her, "I guess retirement is okay, but what I miss the most is goofing off on company time." Next, we turn to qualified plans, and more particularly, a qualified benefit plan. These plans are known by the sections in the IRS code: 401A, 412I, 419A, and a KEO plan. They are rocket fuel. Believe it or not, an individual can sock away over $200,000 per year in a qualified benefit plan. Now, when compared to the qualified benefit plans, there's a qualified contribution plan involving the simple and the SEP. With the simple, if you're 49 and lower, $12,500. If you're 50 and older, $14,500. And with a SEP, look at this number. You can put away in one particular year $52,000 or 25%, whichever is less. These are the current numbers for 2014. Finally, in looking at qualified plans, we'll look at qualified stock plans. Some of the plans are very familiar to people, known as ISOs, ESPs, and ESOPs. An ISO, otherwise known as a statutory incentive stock option, is a plan whereby the employer grants an employee the right to purchase company stock. The amount of stock is limited. The price must be equal to the fair market value on the date of the grant. The date which an employee may purchase the stock normally occurs 3 to 5 years after an employee's hiring date. Now, an ESP is known as a statutory employer stock purchase plan. Similar to an ISO, the employer grants an employee the right to purchase company stock. The amount of stock is also limited, but the price is normally lower than the fair market value on the date of purchase. The date upon which the employee may purchase the stock normally occurs 3 to 5 years after the employee's hiring date. And finally, the ESOP, otherwise known as the Employer Stock Ownership Plan. With this plan, the employer grants an employee the right to own company stock in lieu of wages and salary. The amount of the stock is limited, and the price usually equals the fair market value on the date of the grant. The date is normally once a year. Finally, we have a group of non-qualified plans. But just because they're non-qualified doesn't mean they don't pass IRS scrutiny. They just require a little more additional tax reduction strategies. These include the voluntary deferred compensation plan, controlled executive bonus, split dollar life insurance, rabbi trust and secular trust, top hat plan, golden parachute, and a non-statutory employee stock purchase plan. There's an old proverb, taxes grow without rain. There's a treasure chest of free money buried in your business. Claim it today. This concludes another segment of their webinar entitled The 12 Biggest Tax Mistakes That Cost Business Owners Thousands of Dollars Each Year. This is segment number 11, Missing Retirement Deductions. So, on behalf of TaxExterminator.com, home of the Proactive Tax Plan, I want to thank you for joining me at this seminar, and I welcome you for the final edition, the segment number 12, No Audit Proofing. For a limited time only, I'm giving away a free copy of my tax strategy book entitled 10 Powerful Tax Strategies That Pass IRS Scrutiny. I published the book with Amazon.com and Barnes & Noble, and you can obtain a free copy right now, today, at TaxExterminator.com.